Hello and welcome to the Westpac Macro video. I'm Sean Callow, and joining me today in the studio, senior economist Matthew Hassan. Welcome, Matt.
Thanks.
Okay, well, the housing market, obviously, it's not just Australia. Around the world, many countries the pandemic has produced this great upward pressure on prices. So quite spectacular in New Zealand. Enough for them to take some pretty radical steps. So what did they announce recently that they're planning for the investor market?
So a big change. So for a long time now, I think New Zealand policymakers have grappled with a housing market that's sort of been prone to overheating. We saw lots of macroprudential restrictions and so on. This time they've played a very big card, I think, policy-wise. Essentially, investors were able to deduct interest payments on loans against their rental income, so it was sort of quarantined to just rental income.
Right.
They've removed that ability for New Zealand investors to do that going forward, so no longer do they get a tax deduction. It's also going to be sort of phased in for recent purchases by investors over the last couple of years, so it's even being backdated a little bit.
Oh, okay. Wow.
So it's not quite negative gearing because you couldn't deduct against the wider income, non-rental income prior to that.
Okay.
So they haven't eliminated negative gearing, but really what they're eliminating is sort of a positive gearing tax deduction for investors. Really does shift the dial for the housing market, and it'll be a very big jolt, I suspect. The longer term implications are Kiwi team is still working through expectations, but you would expect some combination of lower prices or weaker than otherwise prices, and perhaps a rise in rents in the mix as well. So it's a big jolt.
Yeah. Okay. And for Australia, that it's a little bit different, but it's not likely to be revisited near term, is it?
I don't think that style of policy is really any chance at all. We had our big debate in the lead into the last federal election about reaching the negative gearing and capital gains tax treatment for investors, and the response in the electorate and the response with the election has been soundly against that. But we are staring into some of the early days of the same sort of issues. We have a housing market that's clearly lifting. The March data out today is going to show the strongest monthly gain in 32 years. It's got all the way back to August '88.
Incredible.
And for Sydney, it's a 3.7% gain in the month for prices.
Is this houses and apartments?
This is all dwellings.
All dwellings.
For Sydney, that equates to a median price that's rising about $1,100 a day.
$1,100 a day. That's our stat for the day.
That's right. I think that's a good one. So it's the pace is really strong. The overall level of heat is not quite at a point where regulators would be looking to respond. So when we look at a variety of measures from a prudential point of view, annual price growth is around 4.5% now. Compare that to New Zealand, where it was well into double digits.
4.5 credit growth.
Price growth.
Price growth.
And when we look at the credit side of things, it's nudging up to around 6 or 7% for owner occupiers, but for investor credit growth, it's still only just tracking 1.4% per annum.
Okay.
So the investors are really still not really driving this story.
That's important.
And we sort of go back to 2015 and 2017 when we did have macroprudential tightening here, and there was, we couldn't go down the route of interest rate rises, and so the regulator looked to tighten. The focus was really around that investor segment, which was seeing credit growth over 10%, and interest-only loans, which is really an investor-specific product, which was capped at 30%. And none of those things are really doing that sort of style of overheating. And even if you look at sort of high, the proportion of high LVR loans to the overall new loans that are going through, it's maybe a couple of percentage points higher than it was a year ago. There's nothing that's, as at December, there was nothing that was really flashing red for the regulator. That will clearly change slowly, but we're still not quite at the point where they might pull the pin on something.
We are, just to clarity, we're recording this before the housing finance numbers, but the recent trend was very much towards owner-occupiers, wasn't it? Like 50% a year or something.
That's
growth
right.
in values.
That's so absolutely driven by owner-occupiers. Investors starting to pick up, but off a very low base, and that's sort of the area that we're really watching most closely. We think that's the one that could draw a response from regulators.
So if we're looking at the RBA in terms of interest rate, the actual interest rates on these loans, the RBA's saying we don't expect to raise the cash rate till 2024, and so essentially they're just renewing their QE and so on. These rates are super low. So we think if this if the housing market builds up steam, then we're looking at this return of these macro-prudential and probably work, by the sound of it.
That's right. It feels inexorable. I think we know that the housing market's in a strong upswing phase now. There's nothing on the horizon that's really going to derail that in a meaningful way.
Yep.
And so at some point it's going to get too much for the regulator, and they've forsworn interest rate policy for 3 or 4 years.
Yep.
So I think we end up in this place eventually, but I don't think we're quite there for.
Yeah. Okay, and building approvals. I want to just touch on overall building approvals. So clearly, it was yesterday a very thankless job forecasting building approvals. Whichever country you're in, there month to month, pretty much impossible. But let's look at the year over year, up 20%. Now, this is happening despite migration. I mean, there's a real change in the composition if we haven't got new migrants and international students who would be maybe more typically in cities, in apartment blocks, but still, this number is so high.
Yeah, it's all the other parts of the housing market. So it's detached houses. It's owner-occupiers, raising funds, buying and building new homes using the home builder grant as part of it as well. It's definitely part of this surge. It's in the other capital cities and regional areas, really. That's where the strength is most pronounced. So Sydney, Melbourne have been fairly slow, and those high-rise, those unit segments are still very low levels of activity. They haven't seen a 20% rise in approvals at all.
Okay.
But once you go to Brisbane, Perth, Adelaide, Hobart, you're talking very strong 50% rises through the year in approvals.
Your thoughts why that is? Is it the fact that they're not so exposed by the migration and
multiple reasons? Yeah. So they've actually had some indirect benefits during COVID because a lot of these states have seen net migration outflows interstate to the major capital cities. And some have even seen some returning to those states during the lockdown period. I think, though, it's more so that the COVID shocks were very minor in the smaller states and regional areas.
Okay, yeah.
And the home builder scheme itself, the income and price caps that were applied to eligibility meant that buyers and building their own homes in these states and smaller regional areas were more likely to qualify. And of course, the grant goes a lot further.
Yes, okay. So the government wasn't subsidising people to build $1 million houses?
No, not at all.
Yeah,
and
so
in some
important
cases, the state government's doubled up the federal assistance as well. So it's really everything outside of the Sydney, Melbourne. The story is starting to show through a little bit in parts of Sydney and Melbourne, the detached houses in particular. But so far, over the last year, the really big gains have been in the other cities and regional areas.
Okay. All right, so to sum up, this trend in building approvals and given demand, population growth back to about zero and so on, where does this leave your overall, let's say, national house price forecast or home price forecast?
So look, we do see price momentum sustaining this year and next. We see a 20% rise over the 2-year period as a whole. The way we're running, we thought 10% this year, 10% next year, but we've put on about 5 or 6% in the first quarter of this year. So the pace is really a lot stronger than we'd anticipated. So some of that looks to be pulling forward. I think the way I view the construction and population story, it's really a risk factor for next year. That's where you may see. So if we don't reopen our external borders, or if we do and we don't get a return to strong migration inflows, then we could be left with an overhang of stock. In a normal year, you would need about 175,000 new dwellings to be built to meet population needs. We're running at about 200,000 at the moment, and the population has slowed under COVID to something that's more like 70 to 100. So that the longer you go with that mismatch, the more likely you are to end up with some significant oversupply issue somewhere. We don't think that's likely to happen, but the difference there is if the external borders stay closed for an additional year, for example, then you could get real problems. But if they reopen as per the current sort of expected timelines, we should be okay.
Yeah, okay. All right, well, so near-term strength, maybe some risks further out, but overall very strong. Wow, okay, all right, a lot to absorb. Thanks very much, Matt.
Thank you.
Thanks everyone for watching, and we'll speak to you next week.